Guys, what a hell week. One of the largest banks in the USA, the Silicon Valley Bank, got bankrupt.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The biggest bank collapse since the 2008 financial crisis.
Over the weekend, the U.S. economy was rocked after Silicon Valley Bank crashed, becoming the second largest bank failure in U.S. history.
Is this a sign that the world economy is worse than ever? Here's the whole scandal and its effects easily explained for you. Let's dive in, guys. Guys, the Silicon Valley Bank lived up to its name as it mainly worked with startup companies and VCs. In short, the Silicon Valley is a region in the west coast of the USA where many startups are founded and many investors or venture capital firms are based. If a venture capital firm likes to invest in a startup company, they have to provide the startup with money. And of course, the money therefore have to be left in a bank account. And the well-known bank exactly for this case was the Silicon Valley Bank. The Silicon Valley Bank managed more than $200 billion in assets, making it the 16th largest bank in the USA. No small fish, right? Suddenly last week we got the news that the stock of the Silicon Valley Bank lost 80% of its market value just in a few days. And we got the news that the FDIC closed the bank.
FDIC has created a vehicle, a separate bank associated with the FDIC, run by the FDIC, that will take over all the assets at Silicon Valley Bank.
But guys, how could it happen that one of the largest banks in the USA got bankrupt overnight? Let's go back a few years to the year 2020 until today. In 2021, we could see that the deposits of the Silicon Valley Bank just doubled compared to the year 2020. It was also doing well in 2022.
Of 2022, it had $175 billion in total deposits. And here is the anatomy of the bank run, right?
Guys, that means that more customers parked more money in an account at the Silicon Valley Bank. This is generally very positive. Why? Well, I hope that everybody who's watching me knows that if you deposit your money into the bank account, the bank usually try to work with it and invest it in different financial products. Yes, banks handle your money, but you don't have to imagine it like this here.
$100 check from my grandma, and my dad said I need to put it in the bank so it can grow over the years.
Well, that's fantastic. A really smart decision, young man. We can put that check in a money market mutual fund. Then we'll reinvest the earnings into foreign currency accounts with compounding interest, and it's gone.
Banks usually invest your money in products with a very low risk, for example, bonds or mortgage-backed securities. And yes, you hear it right, mortgage-backed securities, the financial product which played a significant role in the financial crisis 2008. Guys, in short explanation, mortgage-backed securities are granted by banks or other lenders to home buyers who use their homes as collateral for this loan. When a sufficiently large group of home buyers has taken out such mortgage loans, they are bundled into a package and sold in the form of securities. Banks sell these packages to investors, and investors receive a return on the interest payments of the mortgage loans. Or in more simple words, you take out the loan for a house. The interest you pay goes also into the pockets of the investors who bought these MBS packages from the banks, and that for a really long period. The Silicon Valley Bank invested in such long-running products because of the relatively low risk and because the low interest rates in 2021 forced the banks more or less to do so. Now there was one big problem, which is called the Federal Reserve Bank. Federal Reserve Bank, or how we call it in Europe, the American Central Bank, which decides how much interest rates you get on your money when you leave it on the bank, just raised its interest rates. And now guys, the following happened, and we also saw it in the financial crisis in 2008. Due to the new interest rates environment, investments in so-called US Treasury bonds became more interesting than traditional mortgage-backed securities or other bonds. Let me explain you what a US Treasury bond really is. A US Treasury bond, in a sense, is a promise that the US government borrow money from you and repay it in future plus interest. Especially in a crisis, US Treasury bonds are very popular because they are considered as one of the safest investments there is. They are often held by investors in their portfolio to minimize the risk and to create a stable source of income. And guys, they are stable because, of course, the state is behind them. And guys, however, this means, especially in a crisis for investors, that investments in other products, for example the mortgage-backed securities, become less attractive. Investors rather earn 4 to 5% with 6-month short-long US Treasury bonds than earning 1.5% with long-dated MBS packages. As a result, the prices of long-dated products such as mortgage-backed securities or other bonds, which of course the Silicon Valley Bank had made money from, were extremely dropping. This means if the Silicon Valley Bank would be forced now to sell such kind of products they were of course invested in, they probably would lose a lot of money. Guys, now I think you can imagine how complex this whole tragedy really is. At this point, something interesting happened. Of course, the Silicon Valley Bank is not stupid. Of course, there's a suspicion that investors and customers will withdraw their money from their account. And guys, now imagine the following. What if you as the Silicon Valley Bank have invested in long-dated financial products that run 10, 20 or 30 years and these are all now losing in value, and suddenly all the customers and investors want their money back at the same time? Total collapse. And guys, now something happened that exactly shows how important customer trust is. And now the Silicon Valley Bank announced the following. They announced to sell loans and bonds that were invested with $21 billion to raise an additional $2.25 billion by selling their own stocks to be secured if all customers and investors try to withdraw their money from their bank accounts. Shit happened, guys. In total, the Silicon Valley Bank sold its products with a loss of $1.8 billion. And guys, small explanation, a bank run occurs when all the customers and investors try to withdraw their money from their bank accounts at the same time. You can guess what all customers and investors would do at the first when a bank announced to sell products and to sell loans with a loss just to secure itself. All customers withdraw their money. These pictures just happened last week. Perfect images of an economical crisis. And basically that's it. Because when famous investors, for example like Peter Thiel, recommended to withdraw money from the banks and the bank run happened, all investors sold their stocks from the Silicon Valley Bank and the stock price crashed more than 80%. And now the question, what happens with all the money people were not able to cash out from the Silicon Valley Bank? Well, in the US there's a deposit insurance for up to $250,000 by the FDIC. FDIC was also the agency which closed the Silicon Valley Bank on March 13. So anyone who had up to $250,000 on the bank will get their money back. All the customers who had more in the bank accounts of the Silicon Valley Bank will get a certificate by the FDIC. The FDIC now tries to sell the assets by the Silicon Valley Bank and the customers will get dividends from the sold assets. Probably that will be a percentage return over several years. Pretty crappy, right? That's life. What should you do now and what will happen next? First, guys, I hope that if you have left some money on these banks, you come out with a minimal possible loss. What I know is that the trust of customers and investors to generally the bank system, not only the Silicon Valley Bank, a lot of banks worldwide, is completely destroyed. So this will have an effect on banks worldwide. For example, the Signature Bank or the Credit Suisse in Switzerland. Past when a crisis occurred. Let's talk about 2008, where we also saw a rise of US Treasury bond yields. The crisis really started when these yields were dropping again. The entire US economy suffered. The S&P 500 dropped down by 50%, which is insanely sick. That means, guys, of course we are not out of the woods. Do I think it's realistic that this would repeat itself? In this scenario, yes, but very unlikely. However, something else is happening right now. Both the stock market and the crypto market have been pumping for a few days after the CPI reports were presented and the US inflation decreased again. What we also know is that a lot of investors and startups in the Silicon Valley are affected by this bankruptcy. That means probably we will hear some news of bankrupt companies in the Silicon Valley maybe in a few weeks. To accurately assess what will happen, I definitely recommend to follow the FOCM conference next week. The whole topic definitely will be addressed there. Guys, my name is Samir and I hope I was able to convey this topic, which is complex, to you guys. Please leave a subscription, guys, for more content like this. Stay tuned and see you in the next videos, guys.